How do interest rates affect you? Well, they have a huge impact on all parts of your life. They dictate the cost of financing on everything. In particularly, dramatically increased interest expenses, as we're experiencing right now, negatively impact many things, even if you do not have any debt yourself. Of course, if you have personal debt, such as a car loan or a line of credit, then the cost of servicing that debt has risen significantly. If you have a variable rate mortgage, then that mortgage payment has gone up dramatically. In some cases, that's been brought to my attention. People are now just paying only the interest rate on a variable rate mortgage and no longer paying even the principal, and that's dangerous. If suppose you've got a fixed rate mortgage coming up for renewal, then in that case, you'll shortly be under increasing pressure from much higher interest rates on your mortgage. But because borrowing costs more in many cases, rents have gone up, specifically because building owners themselves have to service even higher interest rates on their own mortgage. And much higher mortgage rates have also virtually halted the real estate market and have significantly dropped prices because people cannot afford higher mortgage rates. Now, many people ask us what modern monetary theory is, sometimes also known as MMT. But first, I must stress that modern monetary theory has absolutely nothing to do with modern portfolio theory or construction, which refers to the scientific and mathematical process used by us at McIver Capital Management to allocate a portfolio to ensure the greatest mathematical probability of success with that portfolio. Instead, modern monetary theory is an extremely flawed academic theory that has lurked and festered for many years in universities. At its core, it's a theory or a belief set about how central banks can use their control over the monetary policy and the supply of money to control the population. MMT argues that spending and printing money by large developed countries should be unrestricted by the resulting national debt they create. That a large national debt is not as crippling as we've been led to believe. And that if the government just prints more money and spends it on large national programs, people will simply have more money and have better free programs. Now that should work, right? The risk and actual effect of applying modern monetary theory is that all of us end up becoming indentured slaves to the state because the state runs everything. The state has to service a very large interest on that massive national debt. The only way to get that money is directly from citizens through taxes and appropriations. Now that's you and I. Or alternatively, the state can go further into debt to pay for those social programs, but that's clearly unsustainable. If that sounds familiar, that's because it is. Far from being modern, such reckless policies and ideologies have been tried in the Soviet Union and more recently in Venezuela and countless other failed states. If there has ever been a time in recent history in which modern monetary theory has been proven to be a dangerous failure, it is now. Thanks for watching. Click the link below to book a meeting with us or subscribe to our channel for more interesting content about the markets and economics.